Good morning. Welcome to What's Up with the Market. Haven't done one for a while, but felt it was time to just talk about this May. Sell in May and go away has been is typically what happens at the beginning of May. People talk about it. I don't know about you, but I didn't hear much discussion about it this year. And therefore, has it been, well, it has been a buy in May and stay, but for how long? And this happens from time to time. We talk about the seasons of the market, and people have done a lot of research on how it's over a long period of time, over many decades. It would have been better to sell in May and go away, and then come back in the and be away for the summer, in the northern hemisphere summer, and then to come back in the autumn time and then invest. But the market doesn't behave that way. And there are some Mays and even Junes and Julys that you want to be in the market, and we can't pick which one it's going to be. So up to this stage, May, certainly, it hasn't been a sell in May and go away. It's certainly been a buy in May and stay, and again, for how long? Right. Just a reminder that everything we cover in these sessions is this generic technical analysis, that I don't use it anywhere else. Is not used in any of our mechanical systems, and I should update that slide to say SPA3 crypto and SPA3 income as well. And none of this generic technical analysis is used to make decisions in any of the public portfolios. We trade them 100% mechanically, and I also don't use any generic technical analysis to make any decisions in my own portfolios. I use and from time to time, I use 100% SPA3 income, SPA3 investor, but from time to time I do take a little bit of money and I do go and test myself, my generic technical analysis skills, and see how they're going. And what I find, in fact, I've done that. I took a small amount, about 40K, and did that in some of the resources in the Australian market. And so I can tell you right now, an update to that is what I find the most difficult thing to do is not that my analysis is wrong per se. It's the call to actions to be in a process, and that process requires me to go and do generic technical analysis regularly, not daily but regularly, because I'm using end of day data. And that's where you'd mostly trip up, is that you haven't got this continuous process in place that's become a habit. And most of the time you make mistakes, it's because that habit isn't instilled in you. You've got other things going on in your life, and how to instill a process. And I've been a mechanical trader for many, many years now, to try and use generic technical analysis on a regular basis and do that as a habit is very, very difficult to do. And that's where mostly you trip up. And this time I've made a little bit of money, not much, but I could have made more had I had a process in, and I'd been checking my generic technical analysis on a day-to-day basis. And it was just a reminder for me. Every now and then I'll step out and I'll go and do a little bit of money, and just to remind me how, if you like, and I'll use this word, blessed, because a customer phoned up today and used that word, talking about his experiences with Sharewell Systems over the last 6 years. And I feel that way too. So I want to remind you of that I enjoy this process, love it, and just love the ongoing continuity of it, and how easy it is to do if we do it 100% mechanically. And so therefore I'm a mechanical trader, and I precisely follow our systems. And I've got a big chunk of money that's out in the public domain for people to follow doing that. But even the ones that are not in the public domain, besides the little one I just fessed up to now, I also use 100% mechanically. Everything that we discuss here today is general investment advice. There's no specific or personal investment advice that is covered here. And I should say this because that's what ASIC tells us to say, is that past performance is not a reliable indicator of future performance. Quote of the day. There's a good, healthy number of people that are in this session, and I don't know if any of you are. All of you are, I'm just looking at the names here, of all of you are in the, I'm just looking at names, there'd be a bunch of you I can see here that I don't think have done an LTTP, a Learn to Trade Properly live session this year, or maybe even last year, but there's a big chunk of people that have, that are just recognizing names. So I'm just going to talk a little bit about System 1 and System 2. Dave and I spoke when we did the 4-week training intensive, which was end of 2023, and bringing in, and I did mention it a couple of times, a little bit about Daniel Kahneman and thinking fast and slow. And Dave's incorporated a lot of that now into the LTTP training, and it just gives us a benchmark of how to communicate. And we're finding, customers are now talking about System 1 and System 2 like it's off without batting an eyelid. So those of you that haven't done LGTP, I just want to bring it into these sessions because this might be the only time you get contact with us for webinars if you haven't done any of those or done any of the recent ones. So Daniel Kahneman talks about System 1 and System 2 thinking. And System 1, this is quote unquote, System 1 operates automatically and quickly with little or no effort and no sense of voluntary control. So this is the domain of where automatic skills, habits, and ego, this is where they sit. They're instinctive. Dave uses the word caveman. And this is your fight and flight mechanisms. These are things that happen with the hardly instantaneous thinking. They're basically, this is where identity lives. This is where trading identity lives. And what we are trying to do with our training, our LTTP training and training live with a small amount of money using sparse-free income is to reform your trading identity to get to that point where you trade mistake-free, not loss-free, but mistake-free, and what that actually means. And so what we are about doing is using System 2, which Daniel Kahneman defines as System 2 allocates attention to the effortful mental activities that demand it, including complex computations. So he makes the point in his book, and he has some discussions, and not only his book, you can look up, there's tons of interviews of him, all over YouTube, is he talks about it's effortful in System 2. So it's a cognitive, you're thinking, this is where you're thinking, you're making decisions, and then you're acting, but you're doing it by thinking through a process to the point that if you do it often enough, that can become part of System 1. And this is how you transform to a new way of thinking in the market. And there's a lot of this is what we are covering in the LTTP today. So I just wanted to just bring that up now without turning this into a full training session, make you aware of that. And those of you that haven't done LTTP or haven't used sparse-free income, that's become our trading system. So everybody who's now doing LTTP only does it with sparse-free income. And just to make you aware of that, if you are not at this stage, I did do a webinar at the beginning of May on this, but thought I'd cover those of you who didn't get to see that webinar and just bring this in. So we're now using terminology all the time, System 1 thinking, System 2 thinking. And if you haven't got the book, certainly go and get it. Thinking, Fast and Slow, Daniel Kahneman. Right, I also wanted to bring your attention before we get into the charts of this. I found this, it's sources Bloomberg, found it on one of the emails that comes into my inbox. So what this is telling is measuring our longer streaks in weeks, winning streaks in the S&P 500 going back to the early 80s. The longest was 1985, which is that early bull market, that secular bull market that started in October 82. And there was another run into 89, obviously after the 87 crash. These are long winning streaks. And I think this is 12, that's 12 weeks up there. And this is 9 weeks. So right now there's been 1, 2, 3, 4 others in the last, 40 years, 1980, 1920, 46 years that have got to this length. And this is the 4th one. So this is a long winning streak by any measure in nearly half a century. So why did I bring that up? Because we're going to look at some charts now, and I can tell you that people have asked me, when am I going to do my next secular bull bear market presentation? Well, it's pretty obvious that we're not close to a secular bear market yet. So I'd just be reinforcing that we're in a secular bull market. That's easy to say. But I do keep an eye on some of the longer term indicators that might be getting down to danger points, which I'll keep doing all the time. And if I feel the need that it's time to start alerting about a secular bear market, maybe being weeks or months away because some of those indicators are pointing that way, then I'll certainly do one of those sessions. But I think it's pretty obvious now in the US anyway, is that we're still in a secular bull market. So just in the context of what I'm going to do today, going through the charts, just bear in mind that this run that we're in now, the streak, this number of weeks, winning weeks in a row, is consecutive weeks in a row, is getting to kind of all-time highs. But what isn't covered here is what happened after those. And it doesn't mean, now just because I'm putting that in front of you, that therefore there's a dead cert that the market's going to fall in a heap this week, next week. Who knows? This could surpass 9085 and go on beyond that. And sure, there's going to be a retracement at some stage, but how deep and how long, we have no idea. And we don't even want to start predicting what that might be. So let's get into beyond charts and have a look at start off with the Dow Jones again, where we normally start. Certainly up there's the last signal was an entry signal using Sparsely Investor, but really what I want to point out here is this relative strength chart at the bottom in the bottom graph over here. So basically, since that's February 2024, and you can go back further, that's the peak back in December 2022. The Dow Jones has been underperforming the S&P 500. So that's a relative comparison to the S&P 500. And that typically means that the broader market is doing better than just the Dow constituents, which typically means bull market conditions. So that's been in place for some time. And if we zoom in, that's certainly the case as well since February this year. So underperforming S&P 500, good thing for a bull market. S&P 500 itself, just on volatility, it's at low levels over here, which means that effectively the trend is maturing. It hasn't been a long trend. This by no means is a long trend on the broader market. We had some sideways movement here for quite some time, a dip there, and then this run up. And of course, all the doomsdayers came out when this happened. And all it was a 38.2% retracement, or slightly more than the run up that had happened since Liberation Day last year in April, when Trump announced all the tariffs. And we've had that run up since then. Ran up, sideways, retracement, breakout. Typical stuff. It's pretty normal, nothing to see there. A retracement we would be looking for when one does happen would be probably a 23.6. So we'll drag that up as it goes up. And we can see the bars are getting a bit narrower here, which typically happens going into a trend. Looking for divergence on the accumulative new high, new low. Doesn't happen that often. It happened in this instance over here. It happened also here prior to Liberation Day. You can see what is divergence. The index going higher peaks, whereas the cumulative new high, new low falling. So there's more new lows leading. So in this rising market, we're getting more stocks making new lows. So a sign of breadth, weakness in the market. And it happened over here too. There's no sign. And that was just this one, the retracement we had into the end of March over here, which was basically the Iran war. But look at that. Did we know the Iran war was happening on 28th of Feb? Yes, certainly we did. Sorry, January. So that is rising, and so nothing to see here yet. There's no breadth of market divergence, even on the advanced decline line. There was another warning signal there, and the same thing happened there on the advanced decline line as well. Nothing there at the moment. Pretty strong run up, there's no doubt. Stronger than that one that came out of back there. There was divergence on, and you could even, depending which peaks we join over here, but I wouldn't say that's a valid divergence yet at this stage, because really we're coming off that peak there to there, and that is rising. But the divergences we have here on the number of stocks that are above their 150-day moving average in the S&P 500 is not a good indicator of, as the other breadth of markets are, as good an indicator as those two when we get divergence. But nonetheless, it's some evidence you can look at. This is a better indicator of market weakness. This is the US dollar index versus the S&P 500. So there's the US dollar index, and I've got this smooth index rate of change, SIROC indicator on the relative strength. And effectively, when this is falling, that means the SIROC's falling. That means it's a risk on. That means it's positive equities conditions that we have at the moment. And you can see the number of times that the market goes in the opposite direction to the US dollar index. US dollar index falling, equities higher. US dollar rising, equities falling. Sometimes one leads the other. We don't know which one is going to be the leader at any given time, but once the relationship develops, it's pretty consistent, and you can go back and look at all of the times there to see the proof of that, and you can download these charts and look at these in your own time. But what we're seeing here is US dollar fell, rose, and just in that little time, markets fell, US dollar rose, US dollar now flattening. There's no rising or falling there, just on the extreme right hand side, but the market is rising. So if you want to look for an early indicator of the direction of the market, if it happens first, is look for a stronger US dollar, but in the basket, the US dollar index, which is measured against 6 currencies. So you can keep an eye on that on a daily basis if you want to look for early signs. Okay, looking at Russell growth versus Russell value. Growth at the top, we had this risk off. There was an early warning sign there in December 2025, and you can see the Russell growth underperformed the value, and now it's the other way around. They're both rising, but the growth is rising by more than the value. So we've got the rising CIROC. Again, now you're going to see all of these comparisons, these intermarket comparisons and correlations. You're going to see the last green line over here with a rising CIROC happened in that March-April timeframe, and they're still valid and open, meaning we are favoring equities at the moment and have been for a number of weeks. This is the consumer discretionary versus consumer staple. Same thing, not really going anywhere, going sideways, consumer discretionary. So there's not a massive amount of these. So this is the discretionary stocks that go into this index, the sector, going sideways though, not much growth, but we have the green line over here, CIROC rising, which means that relatively speaking, there's a bit more strength in consumer discretionary than staple, but neither are shooting the lights out. Put call ratio on the S&P500 index falling. So we got the 250-day moving average, and that falling means that there are more calls out there than puts. So at the moment, the put ratio isn't rising; it's declining, meaning that people aren't hedging their equities positions, and institutions as well. And then we've got the S&P 500 rising in the bottom graph. So that's another risk on favoring equities. This is this is interest rates sitting at. We had interest rates rising. We'll look at the bonds in a moment. Interest rates now starting to fall off over here. Relative strength, which is a 34.13 on the CIROC, falling, which is a risk-on environment. So sure, the interest rates were rising over here, and you can see a bit of volatility, a little bit of volatility in the CIROC, but at the moment, it's also favoring equities on interest rates falling a bit. Looking at bonds, so this is the 20-year, this is TLT, which is an ETF on 20-plus year treasury bonds. And everybody's been writing about, if you follow news, about how bonds are falling, and that is not good for the stock market. And ultimately, that will lead to potentially credit issues, which will then lead on to weakness in equities. Well, what's happened now? The market's continued rising, and towards the end over here, we're starting to see bonds rising and going in sync with the market, which is what should happen. So ideally, you'd want bonds and equities rising, which would mean that interest rates are falling. But obviously bonds, because there's a limit to how low interest rates can go, is that they're not going to have the same volatility and upside potential as what equities will. And therefore, that is why they're seen as a lower risk environment. So bonds are debt markets, and equities are equities markets. Stocks are equities markets. But I also want to point out over here is how often bonds and stocks do not go in the same direction. I do this from time to time, and they spend more time going in the opposite direction than what they do. So every time I've lined all these up, every time you see that rise, the blue, the dark blue rising and the red falling, is how often they are out of kilter. They're going in opposite directions, and you can go back and do that exercise yourself. So when you see a lot of writing happening, which has happened in the last couple of months, about be careful, bonds are rising, falling, then that obviously interest rates rising on the flip side of that, then that's going to be a weakness for stocks. It's a pretty low correlated prediction, but what you will find is there are times that it does happen, and particularly in overly weak markets, that you can go back and look at that correlation and say, gee, tick in the box, it's great. But to me, the US dollar, and I've said this many times, is a far better, the basket, the US dollar index is a far better indication of potential weakness in equities. So read those stories and just remember that. The VIX index is really, really low. Just have a look at the bars, how the range of the bars on the VIX, and just look how tiny these bars are at the moment from high to low. And you can see we've got an ATR-VE down the bottom over here, and it's getting right down to low levels. How often does it get down to the levels we got here, the bottom red line, and these bars just shrink? Okay, now that might be seen as a good thing to justify what's happening in the market now, but the VIX is actually a contrarian indicator. So if there's one little bit of warning, if you like, is to that we are going to, besides the markets having run as much as they have, is that this volatility is very low, and it's also reaching these lower levels over here of this band. So being a contrarian indicator, we should expect some weakness to come soonish, not saying days or maybe even weeks, but this, if you go back and look at how long, it can stay here for long periods of time, month two, it can go up a little bit. Each of these little spikes over here, obviously little retracements in the equities market, but it can stay down there for pretty long periods of time. Look at this going back to 2024. So it doesn't necessarily mean it's going to suddenly spike, but the odds get, the longer this stays, the volatility on the VIX, the daily bars on the VIX stays low, the greater the probability we're going to have some sort of retracement, and we don't know how deep that retracement will be. But remember, we're not predicting here. I will take opportunities when like this to just keep on warning you that the market doesn't go up in a straight line, but we don't want to try and use these indicators to avoid drawdown, because effectively from a mindset perspective, that's system one, trying to avoid emotional pain, trying to avoid discomfort. They are unavoidable in the market, and what we have to do is use a system two process to improve our system one thinking with respect to the market. And sure, bracing yourself for that is good, but embracing drawdown so that you can improve your skills and look forward to how you are going to execute in that environment. So with the view to then recovering out of that discomfort zone of being in drawdown and then breaking out to a new high, recovering, and then your portfolio advancing, is really what we should be doing as trying to improve our skills to grow and develop as better active investors. And this might just be one little opportunity, that's the one little indication that we may be heading for a little bit of weakness. Okay, now we're looking at the Nasdaq Composite. Green line over here rising. There's the relative strength. What am I measuring it again? I'm measuring the Nasdaq Composite against the S&P500. So now we're looking at the more risky side of the market, the Nasdaq Composite compared to S&P 500. So you've got the lowest risk environment is the Dow, which is less volatile than the S&P 500, which is less volatile than the Nasdaq Composite. And we'll look at the Nasdaq 100 in the moment, which is slightly more volatile than the Nasdaq Composite as well. So we will look at that in a moment. But everything here is risk on, broken out, new high. There we go. And up into the stratosphere over here. But is it stratosphere? Well, compared to where it might be in the future, we're down over here. We could be. So stratosphere is probably the wrong word. Something I should also say to you now, just taking off the Dow Jones, I noticed when I was preparing, is that it's cracked 50,000. And when we started doing secular bull bear market discussions way back in 2013, you can go and look at some of the not the predictions, but if we replicated this secular bull market, replicated the one from 1982 to 2000, then a Dow Jones of 100,000 would not be out of the question. And if you just go back and look at periods where major indices have doubled. 50,000 to 100,000 is a doubling of an index, and you can go look at the Nasdaq 100, the S&P 500, and the Nasdaq Composite, and that is not out of the question. It really isn't. I'm not predicting it's going to happen, but getting from it's go and look and see when the Dow was 25,000 and now it's 50,000. Go and look and see when it was 12,500 and when it got to 25,000. And if you go and look at the last 5 years of the euphoric part of the 1982 to 2000 secular bull market, the S&P 500 in those last 5 years went up, I think it was 250%. And the Nasdaq, I think, went up 500%, and I think the biotechs went up 800% in those last 5 years. So if the Nasdaq Composite could go up, if the S&P 500 can do 250% in 5 years, doing 100%, which happened somewhere along there, is not out of the question, because we have not yet, in my view, technical analysis and looking back at history. Remember, no, past performance is not a reliable indicator of future performance, but that secular bull market had euphoria towards the end of it. We have not had euphoria yet. There have been pockets of euphoria now and then, but they've fallen away and dipped away. People have been predicting, the predictors of the market have been saying, AI and tech is done. And then now look what's happened in the last year, just in the month of April. And they were calling the end of it prior to that, because of this weakness that was going across. So what am I meaning by this? Why am I telling you this? Because anything can happen, and we need to really get that into our brains, that anything can happen. Fundamental truth number one. And fundamental truth number two is, I don't need to know what's going to happen next in order to make money in the market. And time again, just looking at price action and looking historically what's happened proves those two fundamental truths all the time. So you don't need to know what's going to happen next in order to make money in the market. So this is the Nasdaq 100. You might not have seen that I even changed the chart there. I did, but it looks pretty similar, doesn't it? But here we have the Nasdaq 100 compared to the S&P 500. Now I'm just going to page back down. Keep an eye on this side of the chart over here. Whoops, sorry, wrong one. I'm going to go back up. Just keep an eye over here. I'm going to page back up. See the difference. So that's the Nasdaq Composite. That's the relative strength line. And comparing, they're both compared to the S&P 500. I'll go back to the Nasdaq 100. It's a steeper line. So the Nasdaq 100 is outperforming the S&P 500 by more than what the Nasdaq Composite is. And that's because of the concentration in the larger cap stocks. So that's theoretically, smaller cap tech stocks in the Nasdaq Composite should do better than, they're more volatile, should do better than the larger cap. There should be more volatility, should lead to more growth, but that hasn't been the case for quite some time. That may flip. Now, I believe that in the euphoric period of the of a secular bull market, that will happen. The smaller cap stocks in the S&P 500, S&P 600, S&P 400, and certainly in the Nasdaq Composite will come to the fore in a euphoric rise in the markets, which will be the end of the secular bull market. We're still not in that period yet. Okay, looking for divergence in the new high, new low on the Nasdaq 100. There certainly none showing at the moment. So that did highlight a potential drop, and that drop did happen. So it worked there. And as it did in the accumulated advanced decline in the Nasdaq 100 as well, but we are not seeing anywhere. Just look at that chart. It's really climbing high. The gradient is pretty steep. No divergence there yet. Okay, and onto the number of stocks above their 150-day moving average on the Nasdaq 100. No divergence there either. In fact, there's a rise over there, but but the market's continued higher, so which negates that signal. Okay, looking at the SOX, which has been the absolute outstander. SOX is the semiconductor sector. This is the leveraged ETF, SOXL. SOXL is absolutely shot the lights out in SPA3 income. But look at how long it actually was in the doldrums. So there was a period there, from June 2024 and all the way through to August 2025. So about 14 months of sideways and down. I mean, that's quite a steep down over there. So it doesn't always do this. And it doesn't mean because it's doing what it's doing now that it's going to keep doing that either. But at the moment, the public portfolio in SPI3 income isn't in Saxel, but I think that there are some in Saxel is in some of the LTTP portfolios, one or two of the LTTP portfolios, the live ones that are trading with real money. So those of you in it, well, it was up 17% last night, so a big bolster. And the SPI3 income public portfolio made a new all-time high last night again. But look at this risk on over here. Happened in when is that? June 2025. It started over there where the relative strength of the Saxel versus the NDX started rising, and we got an indication here on the Ciroc, which is really a Ciroc of the relative strength, and you can see how technical tech stocks, semiconductor sector has been outperforming the Nasdaq 100 for all of that time. So Nasdaq 100 outperforming the Nasdaq Composite, which is outperforming the S&P500, but the SOX is outperforming the Nasdaq 100. So concentration in there, and you want to be able to take advantage of that. And unleveraged portfolios and stocks don't get that much concentration as what you can get in an ETF. Okay, I'm going to do I will get to Anthony's talking about doing a comparison of the S&P 500 and the XJO and detached from the market from US. Steve is saying Euphoria gets a regular mention, but there are times when a bull market ends without this end. And do these times have their own unique characteristics? Steve, absolutely. So we're talking about a bull market there, which is a primary bull market. And when you're talking about secondary and primary bull markets, you don't need Euphoria to end those. Absolutely, 100%. But on a small sample of secular bull markets, which are long term, and we're talking about 13 to 20 year bull markets there, they have all ended with Euphoria. 1929, 1964-5, and 2000 and 1998, 1999 into 2000 have all ended in massive euphoria. So I'm talking specifically there about secular bull markets, not primary bull markets. And Dittmer saying, following on from the success of SPI3 income as a trading system, is there any current research on a shorting system using inverse leveraged ETFs underway at the moment? If so, would it only be would it be activated once we have confirmation that a secular bear market has begun? Right, Dittmar, yeah. I'll cover that at the end of the session. I'll come back to that and finish with that. Okay, let's keep going here. So that's the SOX. We're going to do the. So this is just a note on I did this last time, is looking at the Canadian stock market and how it is outperforming the Australian market. And you can go back long term and see. Sorry, that if you want to see, let's just look at let's go to all data, just to get that. That's an overlay of the Australian market on the Canadian market. And whilst they're not exactly in sync and track each other, you can see the direction is pretty similar for most of the time until we get to this period over here where there's just been massive outperformance of the Canadian market over the Australian market. Right now onto the XAO. So just doing some analysis of the XAO versus and rather than the XJO, much the same. You could overlay them and you could hardly tell the difference between the ASX 200 and the ASX 500, the All Ords. So this is the All Ords. Just look at this massive what happened there? This massive underperformance of the All Ordinaries to the US markets going back to 2009. So it's been a long time. When have we outperformed? From 2002 roughly up to 2009, which was during secular bear market conditions. And we won't go and pull it apart now, but during that period of time, we had a lot of small and mid-cap resource stocks absolutely smashing the lights out. Why? Because there was a commodity boom on them. And that commodity boom has some, we'll see it, look at the moment, and at copper and gold, and just see there has been some strength there. But across the board, Australia just is not taking advantage of the commodity boom that it took advantage of back then. And whilst we're not in a boom right now, there certainly is a lot of action happening in commodity markets that Australia is just not getting its fair share of. And that might be the reason that in this latter section over here, we are just not getting the same go-to as what Canada's getting and other markets are getting around the world. So that's underperformance of the S&P 500. And it's now even just taken another turn down to a steeper level of underperformance of the S&P 500. If you put this against the Nasdaq 100, well, then it would be even worse. And compare it also to the SOX, and it'd be even worse again. And so one of the main reasons for diversifying your investments into the US markets as well is to get access to those sorts of stocks and markets and AI. Sure, there's other markets you could go to in the world and do it. Just look what's happening to South Korea and the Kospi, and you can get access to the Kospi via an ETF in the US market. So there are ways of doing it. But at the moment, the signs are not auguring that well for the Australian market compared to other markets. It's just not reacting in the way that the rest of the world are, or not the rest of the world, but some of the main markets in the world. So hopefully that answers your question. Who asked that, Anthony? And will it change? I don't know. We'll just have to wait and see. But you might want to look at your core and your satellites and see if you don't want to do some rearrangement. I'm not saying get out of the Australian market and only into the US market, but you may want to change your weightings on your satellites. But don't do that just because I said so here. Go and do this analysis and document it and keep it and say, okay, I changed the breakdown, the asset allocation between my satellites and maybe even your core, based on this analysis and where it's going. There might be some big reasons that are not easy to change that's causing this. And without me talking about what those are, you can probably fill in the gaps yourself, because this is a technical analysis, charting, investing webinar. It's not anything outside of that. So hopefully that answers the question. The Australian dollar, which is a little bit surprising, is that it is rising, because that typically means there would either be weakness in the US dollar, which hasn't been compared to the US dollar index and other indices, other currencies. The US dollar hasn't been as weak, or those other currencies haven't been as strong as what the Australian dollar has been against it. And typically this would happen when there's money coming into the country, and you might see that going into the equities markets or somewhere else, but it's obviously not going into the equities, into the All Ords or the XJO to the extent that the money is, if it is coming into the country, and if that's what's causing it, because that doesn't look like it's all being done on weakness only of US dollar. Okay, we'll flip now quickly to commodities. The CRB index has had a jump here. That is mainly due to oil. And just looking at where this has gone long term, this would tell you that wasn't all oil there. There were other commodities in that pushing that up. And there's this long term, in fact, this also requires an all data CRB index. Up, down, and this is the period here where the Australian stock market did very, very well in this period. Commodities boom. A bit of a commodities boom over here. Australia did do relatively well in that period, but this has only been oil. Otherwise, the broader basket of commodities is really just going sideways there. So that might explain some of it. Looking at gold, and I'm comparing it to the S&P 500 over here, certainly outperformed and that's at 1900 was their previous all-time high. Strong breakout. Now this channel has been broken to the downside. I have moved this slightly lower in the past. I'm not going to move it yet, but we are looking at I've got a Fibonacci here that runs all the way back to the breakout, I think it is. here, to the breakout, or no, sorry, to the trough over there. So that run all the way up over here with not much of a breather. You can see this is the biggest breather it's taking at the moment. This is a log chart, so those are all relative, just to the naked eye. This is now sitting on a 38, just got to 38.2, definitely downtrend here in the short to medium term. Will it go to 38.2 or will it go all the way to 50? Underperforming equities at the moment, so we might see a bit of a longer term, deeper retracement in gold in the near future. At this stage, it doesn't look like there's a breakout. This is silver. Silver slightly outperformed there, massively outperformed, bit of a catch up, and been doing much the same as gold over that period of time. Copper, on the other hand, has just made a new all-time high. We've got data back to 1978 here. And that is there's definitely a breakout there. Lots of resistance at that level. New high, new level, some resistance there. Now breakout. This is a clear technical analysis breakout. Breakout to the upside, retest support, which was previously resistance, and now looking to almost make another another all-time high. Outperformance here of I've got this against gold. So yeah, we see underperformance of gold for many, many years. And even in this period of time over here, matching weaker than gold, and now just a little bit of an uptick. It's had some of these upticks along the way, but this looks like a longer uptick relative to gold that we've seen for some time. So this should, they talk about copper being a bellwether, Dr. Copper and all that, and you've heard me say it before. But over the last, basically since the boom run, the commodities boom that happened in the 2000s, the first 10 years of the century, runs in copper back then led to that going into small and mid-cap resources in Australia. That's not happening at the moment to the extent it happened over there, and the pockets are fewer and further between, and there just seems to be a confusion in the small and mid-caps area in the Australian market. So let's see what happens this time. Let's see if copper really takes off, how our small and mid-cap resource stocks react. But there just seems to be a lot of negativity around at the moment in the Australian market. Okay, this is oil. Obviously, massive run-up into Iran. Sideways volatility over here. Massive confusion about what to do. Obviously, reacting to news on a daily basis. But we saw the run-up there relative to, what have I got there? To equities, to the S&P 500. But there's been weakness against ever since, when is that? The end of March. So the whole of April and May, there's been weakness relative to equities, and oil has kind of just gone sideways. But it is at a support level over here, and this is going to be driven by news more than anything else. Okay, on to cryptos. I'm going to do 3 cryptos. Let's just zoom right out. There's the run-up, Bitcoin outperforming the Nasdaq, and now been underperforming the Nasdaq for quite some time. Since when is that? Hit peaked in July of last year, so coming on for 10 months, 11 months. Underperformed the Nasdaq, and now this is we've had a couple of trades in this since we released SPA 3 crypto. There would have been, there's 1, 2, pretty short term, 4 trades have been signaled since, and there's been no uptrend here whatsoever. And this weakness, this bar over here, is sitting on a long term. Just go back. There's this support, which was that resistance there. And if it falls below this level, it could fall quite a long way. I have put the fib on here. Let's just have a look at the fib. We spoke a little while ago about 78.6% retracements, 61.8 and 78.6% retracements. You can go back in your own time and look at the 78.6 and the 61.8. So I've got here on this chart, and there is a relatively high probability that after this long run up here, that there is a 78.6% retracement in Bitcoin, which would take it to around about 40,000. Not saying it's going to happen, but it's that's just looking at history and seeing if it does repeat. Remember, it's not a reliable indicator of future performance, but this is showing weakness. There's no doubt about it. There's not much strength being seen in the crypto markets at the moment, and that is Ethereum. Ethereum hasn't really made the new high and breakout out of this channel that Bitcoin did, and this could see a fall to at least these lows over here, and maybe even down to this level here, which is just above 1,000. So weakness, and let's have a look at Ripple. And Ripple, just I should have done a relative strength. I've got a relative strength. So that's Ripple against the Bitcoin. It has little runs of outperformance, massive outperformance, but most of the time, Ripple underperforms Bitcoin. We've got a track record of that now, going back to, 2018, and of late there's been a massive indecision in what's happening with Ripple, and now we can see this is a pretty strong red candle, red bar here, below support. I tried to see if I could bring this support. I'll just take that off. This support zone lower, and I really cannot see any evidence to bring this lower. So that is a clear breakdown below this support level. What should happen from here is, and it might be leading because it's obviously the reason I showed you it's underperforming, it's weaker than Bitcoin, is that you're going to see weakness in the weakest first, and this might be a lead, really showing from a technical analysis perspective that Ripple's going to lead weakness, and then we'll see what the others do, but it's not looking very good. This is a 78.6% retracement of that run-up, that happened from there to there. And this could see a retrace. When you get past 78.6, as if it does, typically you go to 100% retracement. Could stop at 88.6, but that's still a way down. But there's weakness in the crypto markets. There's no doubt about it. Okay, we'll just finish on platinum and palladium, and so we'll have a look at uranium and thermal coal as well. Run up in palladium, in platinum. We spoke about the catch up to gold. Gold's going sideways now, so is platinum. This has been a 50% retracement. That's a 38 point. It's a 50% retracement of that run up, which is classic stuff. Will it break out from here? I think it's going to depend on gold, and platinum is the same. Platinum has shown even more weakness palladium has shown more weakness than platinum. Sorry, getting mixed up. Okay, and uranium, just to finish, is in a slight uptrend. Is sitting at pretty high levels. That's its peak back there in 2007. Under the actual ETF itself over here. This is comparing the raw price in uranium to the URA ETF. And the ETF certainly does not track the price very well. And that is iron ore, just going sideways, not going anywhere, as is thermal coal, also sitting around going sideways as well. Okay, now I'm going to go to, so commodities are not really smashing the lights out, except for copper. We'll see if the others come along for the ride. Okay, let's just I'll go back to the S&P500. Oh, sorry, and I'll just answer Dietmar's question. SP, and I'll just answer Dietmar's question. So just to remind you, Dietmar's question was: are we doing any research in the in inverse ETFs? The answer to that is yes. We're not having much. We're not getting great outcomes at the moment because we're looking at inverse ETFs. And inverse ETFs, without going into too much detail, let's look at long ETFs to start with. So long ETFs suffer is probably a strong word because you would hardly notice it looking at the charts. But there is you've heard us talk about volatility drag in the past, mostly when we were doing research back in the 2010, 11, 12 area. And we talk about volatility drag on equity curves. That's basically consecutive losses. But there's also volatility drag in options, which is led by time decay and implied volatility. And there's also volatility drag in leveraged ETFs. Now I'm just talking about long ETFs here, and that is caused by the formula that the providers use of the ETFs to get leverage. And so a little bit of that is, and I spoke about this when we released SPA3 income. Is that you don't get a unified 3-to-1 matching of the index if you're going to 3-to-1 if you're in a ×3 leverage ETF or a ×2, and the difference is volatility drag. And that is the pricing of leverage, that is going to the futures market, but it's also in the way that the leverage works on a day-to-day basis when they calculate the growth. So for instance, and without going into too much detail, if something goes up by 10% and then goes down by 10%, you don't end up at the same place as where you started. So a dollar grow by 10%, decrease by 10%, you don't end up back at a dollar. And you can go and do this exercise yourself. And that difference is called volatility drag. Do that over numerous days, and that's what the difference is. So that volatility drag happens in long ETFs. In inverse ETFs, it happens to a greater extent. So not only are you with an inverse ETF, and I know theoretically at the top at high level you go, oh well, we'll just do an inverse ETF because that'll go up when the market goes down. But when the market's going up, the inverse ETF is going down, and is going down at a far greater rate than what the market's going down. So to try and create a system that has that is to generate profit out of a price action that has a negative edge, i.e. the volatility drag plus the fact that markets are rigged to go up because all the laggards fall out of the index and the goodies come into it, is very, very difficult. So we are trying to, which means it'll be a totally different system. Why? Because it's and if you have a look at the inverse ETFs, so go and look at SQQQ rather than TQQQ and look at some of those, and they're awful. Well, why don't we just do it now rather than talk about it? Okay, so there's SQQQ, and so that and that's over the lifetime of it. So you can see there's a massive negative edge there. So what we're trying to do is we are trying to get little bit pockets of positivity out of these periods here, and you can see that they're few and far between. So so that falling, that price action falling, is a combination of the market rising and also this falling at 3 times the rate, but also the volatility drag in the calculation. So to get a positive edge out of that is very, very difficult because you're getting lots and lots of, to be able to get in early enough, you're going to get into some of these others over here, which you just can't get out of in time. So we have managed to get a not so bad negative edge. And the question that Dietmar said, will we go to these when we're in a secular bear market and maybe put some overall timing on? Well, that's what we're grappling with at the moment. Ideally, what you do, the way hedge funds trade, is they trade their long and their short system all the time. And the short system is a drag on the long system while markets are rising. But then when markets fall, without them having to say, right, I'm going to turn on the shorting system now, they automatically kick in and they become a hedge to the long portfolio, to the long edges. Excuse me. So that is what we are trying to work out now. And it's pretty difficult. We've had a bash of trying to do this in the past, and we haven't been successful with it. It's our hedging, if you like, our shorting has been cash. So with the focus on a small universe and there being leverage, and maybe not even, and what we're looking at is maybe even not having to use leveraged ETFs because the volatility drag that comes into a leveraged ETF, it might be better just to go to an inverse ETF that has no leverage in it, and at least get some positive growth out of a falling market with an unleveraged ETF. So we are looking at all of those combinations, and it's taking quite some time. And I feel from the results we've seen so far that well, I know the project's not over. Why is it over? Because we feel there is some potential there. We just have to find it. It's just going to take a bit longer than what it takes to find a long edge. Why? Because you're trading in a rig biased market that has an upward bias. The other thing to mention is that we are also looking at expanding the SPA3 income universe as well. And to do that, we are having to reduce one of our requirements, and that is having 7 to 10 years of data. On the basis that some of the ETFs we're looking at are ×2 equity stock ETFs like Tesla and Apple and those, where the ETF is based on an underlying, so the ETF being the derivative based on underlying, that has years of data. So what we are doing is measuring the tracking of the ×2 ETF for the stock to measure correlation. If the correlation is there and can prove itself, and the only difference really is the leverage, then we can trust the data that is tracking the data, but just on the underlying, but just on a ×2 leverage basis. In which case, we can put some relevance to the data that is available in the underlying stock prior to the ETF actually starting trading. So we're looking at doing that to expand the universe and get some and to take advantage of leverage in the SPA3 in a system such as SPA3 income that we have with overboard exits and time stops and things like that. So that's ongoing with a view to, and I've explained this to a number of customers who've rung in and I wanted to know a bit more. So I'm telling you now is to get some more open positions into the SPA3 income portfolios. I'd like to get it to 7 ideally, which would bring the position sizes down rather than sitting at 20% position sizes. We'll get into the low teens, and that would reduce risk in the event of the market falling in a heap. So those are the things that are happening with SPA3 income. I can also tell you that we've developed our tools, our research tools, to be able to expand our team who can actually run research projects. And before somebody asked it, nobody has, but I think it has been asked before, is we are looking to bring the overboard exit into SPA3 Investor and how that plays out. We don't want to turn it into a swing trading system because I don't believe that's the best way to trade equities, but we want to look at reducing end of trade drawdown in some of the stocks that have wide stops before getting out, and we can actually capture profit before the end of trade drawdown kicks in to take us out with an ATR TSL. So that's what's going on in research. I'll just some more questions over here. Gordon's asking a reference to the South Korean market. There is a leveraged ETF called Karu, K for so that's Kilo, October, Romeo, Uniform, Koro, K-O-R-U, which has been doing pretty good. I'm sure it has. This may be a candidate for the income portfolio. Well, we'll have a look at it. Probably didn't get into it last time because of maybe short data, but we'll certainly look at that ETF. Thanks, Gordon. And Nick is just saying, thanks, Gary. The shorting discussion makes sense. The non-leveraged ETF short cover. Absolutely. We're just looking for some gain rather than just being 100% in cash. So we're including that in our research as well. Okay. Well, that's it. We've been going for just on an hour. As I said before, I prefer to have these that maybe go for an hour, a little bit longer than half an hour, 40 minutes, and do them less frequently. I think there's always value. I certainly have value myself in doing this generic technical analysis, which I don't really do until I do these sessions. So hopefully you've got benefit out of it, and we'll see when the next one is. Certainly, if the market starts falling in a heap and there's lots of negativity around, I'll jump on, because that'll definitely be a time that we should hold one of these and just look at what all the indicators are telling us. So thank you for your time. I wish you consistent and objective and peaceful active investing and trading.